Let us talk about a math equation that completely changes how wealth is built in India. If you invest 10,000 rupees every month in a mutual fund, assuming a 12% annual return, you will have roughly 1 crore rupees after 20 years. That is the standard systematic investment plan pitch everyone knows. But if you take that exact same 10,000 rupees SIP and increase your contribution by just 10% every year, your final amount does not just go up a little bit, it jumps to nearly 2 crore rupees. You literally double your wealth by making one small automated tweak. Yet, most investors just set a flat SIP and forget it for decades. We are taught that discipline is everything. Just start an SIP and do not stop it. But while flat SIPs build discipline, they actually become declining investments in real terms. Think about India's inflation. The official consumer price index might hover around 5 or 6%, but real inflation for things that actually matter, like higher education and healthcare, is running at 10 to 14%. A 10,000 rupees SIP today will feel like investing just 3,000 rupees in 25 years because the purchasing power of that money is constantly dropping. If your income goes up every year but your investment amount stays flat, you are actively choosing to underfund your own future. That is where the Step-Up SIP comes into the picture. The Step-Up SIP is simply an automated instruction to your mutual fund house to increase your monthly investment by a specific percentage every 12 months. There is a massive misconception here. People think a Step-Up SIP increases your market risk. The reality is that Step-Ups only increase your contribution amount, not the market volatility or the underlying fund's risk profile. You are just deploying more capital as your capacity to save grows. Another common myth is that you need to start a brand new SIP every time your salary increases. That is not how it works. Step-Up is an automated feature added to your existing SIP that upgrades your investment without generating new folios or paperwork. Now, how do you decide the Step-Up amount? I always point to the 50% appraisal rule. When you get your annual salary increment, calculate the post-tax increase. Allocate exactly 50% of that increment directly to your SIP Step-Up. If your take-home pay goes up by 10,000 rupees a month, increase your SIPs by 5,000 rupees. You still get money to upgrade your lifestyle while permanently upgrading your wealth. But most people stop here, which is a mistake. They upgrade their car or move to a bigger flat, and suddenly the entire increment is swallowed by lifestyle inflation. To stop lifestyle creep, you must synchronize your Step-Ups with your appraisal month. If your company pays out increments in April, mandate your Step-Up to trigger in May. The money gets invested before you even get used to seeing it in your bank account. For young professionals in their 20s, this strategy is a game changer. Young earners usually start with a lower base salary. You can start very small, say 5,000 rupees a month, but use a highly aggressive Step-Up rate of 15%. Because your salary will grow much faster in the first decade of your career, your SIPs will effortlessly scale up to match your income growth without causing any financial strain in your early years. If you are worried about committing to future payments, let me address another fear. People think if they face a financial crunch, they are permanently locked into unaffordable high monthly payments. The reality is completely different. You can easily pause, modify, or cancel the Step-Up mandate at any time using your broker app if your income stalls or drops. Furthermore, asset management company platforms let you set a top-up cap. You can instruct the system to step up your SIP by 10% every year until the monthly amount reaches 50,000 rupees and then stop stepping up. This ensures your monthly SIP never exceeds your realistic long-term budget. Now here's where it gets interesting technically. Previously, setting this up was a headache with physical forms and approvals. Today, execution is completely seamless. Platforms like Grow and Zerodha use UPI Autopay to seamlessly automate annual step-ups. You authorize the mandate once on your phone, and the system handles the increments automatically without manual NACH form rejections. However, because step-up SIPs build such massive capital over 10 or 20 years, you need to be hyper-aware of your costs and taxes. Let us talk about expense ratios first. When your corpus crosses 50 lakhs or 1 crore, the expense ratio of a regular mutual fund plan becomes a heavy anchor. A difference of 1% in expense ratio on a 2 crore corpus means you are paying 2 lakh rupees a year just in commissions. Because step-ups accelerate your portfolio size so rapidly, regular plan expense ratios drain your profit significantly. Choose direct funds. Then we have the new long-term capital gains tax reality. For the financial year 2025 to 2026, the LTCG tax stands at 12.5% on gains exceeding 1,25,000 rupees. When you run a step-up SIP for 15 years, your final corpus will have massive embedded gains. You cannot just ignore tax planning until the end. With massive step-up corpuses, you need annual tax harvesting. Yearly, sell and immediately buy back units to book tax-free gains up to the 1,25,000 rupees limit. Over 2 decades, this simple trick saves you lakhs in future taxes. And this is the part most investors absolutely overlook when they finally decide to withdraw their money. Mutual fund redemptions follow the first-in, first-out method. The units you bought first are sold first. But remember, every single monthly SIP installment is considered a fresh purchase. If you've been aggressively stepping up your SIP right until your retirement year, your final few installments will be very large amounts. If you redeem your entire corpus at once, the units purchased in the last 12 months will attract a short-term capital gains tax of 20%. The practical takeaway here is to completely stop your step-ups and regular SIPs at least 12 to 15 months before you plan a major withdrawal. This ensures your entire corpus qualifies for the lower LTCG rate. What this means is you must strictly link your mutual fund investments to your annual income growth. Please remember that everything we have covered today is purely for your learning. Your personal financial decisions should always be based on your own independent research and, if needed, personalized guidance from a fully qualified financial advisor. If this content helped you, make sure to subscribe and share it with someone who needs to hear this message. Also, please click the link in the description for Step Up SIP Calculator to run your own custom numbers.